Evolve or Perish, Chapter 12. Banks' money and interest rates. Some fundamental changes have been taking place in our economic system over a long period of time. The nature of these changes may not have been apparent to all observers. They present many phases, and if we do not see the complete picture, the partial views are likely to be confusing. The situation is becoming critical, but the elements in it are the same as in the past, only their magnitude is changed. Reckless government borrowing has been assigned as the cause of our unhealthy financial situation. They claim that the unhealthy money situation is due to reckless government borrowing, indulged in to finance the relief of the unemployed who are without jobs, because bankers, businessmen, and others of like mind have repeatedly declared during recent years that business is afraid to go ahead and put idle money to use because of the uncertainty caused by the government policies. It's an endless circle. If commentators would do some real thinking and get some rock-bottom facts of the present situation, they would change their opinions. We can take as a starting point for some real thinking the fact that our whole financial structure is in an unhealthy state, and that there are real dangers of inflation or other critical developments. Banks are loaded up with money. There is a great lack of demand for use of the money, supposedly due to the governmentally inspired timidity of business. Let us take a look back through the records and see just what the present situation is and what led up to it. Here are the figures on bank deposits and loans made by the banks during the past 60 years. These figures do not mean much as they stand, but their significance becomes apparent when we present them as the ratio of deposits to loans. It is easier to grasp the changes indicated by the variations in the deposit-loan ratio when they are present in graphical form in the accompanying chart. Figure 28. A quick scanning of this chart reveals some very interesting and important facts. The first observation is that the present situation is very directly related to preceding situations, and that there has been a systemic development which has been progressing in consistent fashion for a long period of years. The present situation is the last straw added to a previous burden built up at an ever-increasing rate during many decades. There have been minor ups and downs by which the changes deviated from a very clearly defined rate of growth of the deposits-loan ratio that continued to express itself with mathematical precision. There was an almost vertical rise in the curve during the first year of the Roosevelt administration Democratic, but it is a straight-line continuation of the rise that took place during the last 3 years of the Hoover administration Republican. The rise during the Harding Republican and Coolidge Republican administrations parallels that of both Hoover and Roosevelt. The movement goes back with remarkable consistency to the administration of Grant, through 3 Democratic and 7 Republican administrations. We have had both political parties in power for varying periods during the time covered by this chart, but the changing of party in power has had no effect on the systematic development that was taking place in our financial structure. The clue to the cause of the trouble is to be found in the smooth upward turning curve in the chart. To those who do not understand the significance of this curve, there will appear a stranger upward trend since 1920, or the beginning of what is called the post-war period. And it is easy for them to draw the conclusion that something that took place at that time or immediately preceding it. They would be very much in error in reading such a conclusion. The smooth curve is, or closely approximates to, a parabola. To anyone who has had some acquaintance with mathematics, it would be perfectly clear that there is no change in the curve at any point. The rate of change in the curve was just as great from 1870 to 1890, as it was from 1910 to 1930, strange as it may seem. From 1870 to 1890, there was a 6-point rise in the ratio, from 0.75 to 0.81. From 1890 to 1910, the next 20-year period, was a 12-point rise, from 0.81 to 0.93, or double the amount of the rise in the previous period. In the next 20-year period, from 1910 to 1930, the rise was from 0.93 to 0.25, or 32 points, or somewhat more than double the increase in the preceding 20-year period. If we keep the present financial system in operation, making the very doubtful assumption that its continued operation is possible, the ratio of deposits to loans will continue to increase at the same acceleration rate of increase that has been effective in the past. By 1940, the ratio deposits to loans would be in the neighborhood of 10 to 1 at the rate of change prevailing since 1920, and by 1950, about 100 to 1. Such figures are fantastic. Yet they are clearly predicted by past and present manifestations of the system we are operating. It would be well to keep in mind, particularly for those people who are inclined to attribute to the administration in power at any time in Washington blame or credit for economic conditions, that during the Republican administration in the 20s, we were retiring government bonds at a rapid rate, paying off our indebtedness through governmental thrift, and yet the deposit-loan ratio rose at just as rapid a rate as it did when a Democratic administration went into power during the Depression and started reckless, extravagant spending. We are deceived by government bond operations. Blaming economic effects on bond operations is placing blame or credit in the wrong place. They are the immediate producers of effects, but the primary cause are far removed from them. When a man is murdered by shooting, the bullet that enters his brain is the immediate cause of his death, but behind the bullet was the explosives in the cartridge, and behind that was the gun, and behind the gun was the man who pulled the trigger. So it is with our government bonds. Behind these are the business conditions, and behind them are an economic system not functioning properly, and behind that is the men in the individual positions of power and responsibility who rob the workers of a large share of their earnings and converted it into capital, which becomes unused and unusable bank deposits that build up the excessive ratio of deposits to loans. Our banks no longer function in the way they formerly did. The banks formerly made the loans that made possible commercial expansion. The businessmen made use of the loan facilities of the banks. Today, the corporations build up large surplus and reserve funds and cash holdings which they keep on deposit in banks. These funds were built up to a slight extent out of undistributed profits, but to a much larger extent, they were extracted from the gross income which should not be pilfered for this purpose. When money is to be spent for an expansion in any department of the business, it is no longer necessary for the corporation to go to its bank and obtain a loan. Instead, it digs into its idle surplus cash and uses that. The corporation in this way has saved the cost of hiring money. It also, in this way, obtains full possession and ownership of money, to most of which it has no title whatever. The bank has failed to make a loan to the corporation and earn interest. The unused balance in the bank maintained by the corporation was available for loans to others, but, unfortunately for the bank, the amount of cash available was far in excess of the demand for loans. The bank was functioning as a strongbox instead of as a loan and deposit institution, and there is no profit in that operation for the bank. Not only does the bank lose possible loans to its depositor corporation, but the corporation uses its deposits to enable it to function as banker. In order to facilitate its order-getting activities, it is quite the usual thing for corporations to finance activities of customers, which under earlier plans would have been financed by the customer seeking a loan at its bank in order to finance its purchases. This makes a satisfactory buyer-seller situation for the seller, giving him preferred relations with buyer, and is an advantageous first step toward eventual absorption of the buyer organization. The types of depositors who had been the best customers of the banks have become independent of the banks, and worse still have taken over the functions of the banks. The resulting situation has worked to the disadvantage of the remainder of the community. The vast bulk of the population fail to share in the increase of wealth. They become relatively poorer as time goes by. They become tenants to absentee landlord owners of farms and commercial and business properties, or heavily mortgaged holders of such properties. Their credit rating is not satisfactory to the banks, and they not only are poor depositors, but inadequate to use the loan facilities of the banks to engage in business developments that would enable them to earn profits that would permit them to advance toward even a low-level independence. Banks have played the game of the big corporations, and frequently the relations between them have been of an interlocking nature. The banking structure of the country is such that the actions and attitudes of the big banks dominate the actions and attitudes of the smaller banks. As a result, the entire banking structure has become a dependent adjunct of the highly centralized corporate structure of the country. Its functions have passed through a radical change, and it has worked itself into a highly unstable state. The instability will continue to exist and will increase in extent as long as the causative factors continue to operate. The bank holiday of recent memory had the roots of its cause in the whole economic situation spread through the many decades of its unhealthy development. The conditions existing at the time of the closing of the banks and during the immediate preceding years were an extremely small fraction of the whole cause. They were the last straw. Nothing that is done to the political auspices of the government or its financial operations will be effective in improving the banking or general economic situation. Stability will come only when a fundamentally honest distribution of the money and wealth moving through the economic structure has been made effective. One needs but little ability as a prophet to look ahead a decade and visualize conditions if bank deposits continue to change with respect to loans as they have been changing for the past nearly 3/4 of a century, as shown by the data presented. Deposits of greater and greater magnitudes, for which there will be constantly decreasing use as capital, will concentrate in the hands of fewer and fewer people. The bank and economic structure, in trying to adjust itself to these critical developments, may pass through destructive changes. The equally certain change that will be forced by conditions is one in which such money will become completely devaluated as an interest or dividend earning medium. The evidence that this devaluation of capital money is taking place is to be found in the changes in the interest rate, or earning power of money. There have been some very precipitate drops during the past few years, as shown in the accompanying chart, Figure 30, analyst data for the Depression years 1929 to 1935. That this is not a transitory phenomenon due directly to the Depression conditions is indicated by the downward movement of interest rates during the past century, data of Colonel Ayres, Cleveland Trust Company, Figure 29. The movement of interest rates must be considered in connection with other money factors. When this downward movement of interest rates, from 10% in 1930 to 2% in 1935, is so considered in association with the mounting volumes of unused and unusable money in the banks, it becomes apparent that the next development will be negative interest rates. This means that money will pay a premium to anyone who will borrow and use it, instead of demanding that payment of interest be made by borrowers for its use. Such a development would apply corrective factors to our present situation and would reduce the instability of our whole financial structure. But the mechanisms involved would be so inconsistent with the present attitudes of moneymen and bankers that the use of negative interest rates as a corrective device would be quite impractical. The situation, however, that is rushing us unavoidably into the negative interest realm is so widespread throughout the whole economic system that we will be forced to make other changes that will eliminate the present conditions necessitating negative interest rates. These changes will be discussed elsewhere in this volume.